Hello, intelligent people. Welcome to IPMIPOD, Intelligent People Meet in Podcast. I'm Michelle, your host, and today's episode, we will discuss about interesting discussions about influencing and negotiation process in Heinz company acquired by Berkshire Hathaway and 3G Capital. Firstly, check out this video to learn about Heinz as a global food processing company.
Heinz comes from Henry Heinz, whose their original hit product was pickles. That's 1996. He came up with the idea of advertising that he sold 57 varieties. By the time he died in 1919, his company had 25 factories that employed 6,500 people. First successes outside of condiments was baby food. New product on the market made by an already trusted name like Heinz was well received. Another early market for Heinz that I think is interesting was tuna, briefly making Heinz the biggest tuna company in Heinz used to be one of the country's biggest pet food companies. On my list is frozen foods, and around that time when they entered into multiple deals to sell licensed frozen food products, probably the most notable ones being Boston Market in 1999, just months after their bankruptcy, and TGI Fridays in 2001. So when you see those at the grocery store, they are made by Heinz. It is not a complete list. Heinz has sold so many things over the years that my list is meant to be the categories that I found to be the most significant or interesting to talk about. Because in 2013, big things started happening at Heinz. That year, for the first time ever, Heinz themselves was acquired. They were bought by Warren Buffett's company, Berkshire Hathaway, and a Brazilian investment firm called 3G Capital in a deal valued at $23 billion. Remember, before any of this happened, Heinz had grown into a company with well over $10 billion in sales each year. This about Heinz, I think it's easy enough to mistake them for a basic ketchup company, or maybe one that has ventured into a few other products, but this is a pretty extensive history. It has been over a century, with a lot happening with them in a lot of different areas, so any thoughts yet?
Intelligent people, we already see the brief about Heinz company, and now I will ask Mr. Handito as the financial expert to analyze the Heinz financial report. Of course, we want to know why Berkshire Hathaway and 3G Capital are interested in acquiring the Heinz company. So what do you think, Mr. Handito?
Thank you, Michelle, for providing me with Heinz financial report. I will now begin analyzing the key financial aspect of the company. Let's start by looking at Heinz revenue trends over the past few years and compare it to the competitor. From the report, we can see that Heinz revenue has been downward from 2012 to 2013 and going up a bit in 2014. Next, the EBITDA growth ratio that measures corporate profitability. The results were lower than 10, which means Heinz is not in good conditions for this ratio. Then we have EPS growth that measure the value earning per outstanding share of common stock. The results were lower than 20, which also means Heinz is not in good condition for this ratio. On the next page, we have the gross margin ratio that compares gross profit with its revenue as a percentage. All the results were higher than 10, which means Heinz is in good condition for this ratio. Next, the EBITDA margin ratio measures the income generated from percentage of revenue. The result was higher than 10, which means Heinz is not in good condition for this ratio. Next, the net margin, which measures company operating profit as a percentage of its revenue. The result was lower than 10, which means Heinz is not condition for this ratio. On the next page, we have return on asset ratio, which measure how profitable a company is in relation to its total assets. The results were higher than 5, which means Heinz is in good condition for this ratio. Next, the return on equity ratio that measures the sum of declared dividends issued by a company for every ordinary share outstanding. The results were higher than 5, which means Heinz is not in good condition for this ratio. Next, the dividend per share that measures company's net income dividends by its shareholder equity. The results were lower than 15, which means Heinz is not in good condition for this ratio. Okay, on the next page, we have net debt divided by EBITDA, which shows how many years it will take for a company to pay back its debt if net debt and EBITDA are holds constant. The results were lower than 3, which means Heinz is in good condition for its ratio. Next, the debt divided by equity shows the relative contribution of the creditors and shareholders or owners in the capital employed in the business. The results were higher than 1, which means Heinz is not in good condition for this ratio. Next, the asset divided by equity that shows the relationship of the total asset of the firm to the part owned by shareholders. The results were higher than 2, which means Heinz is not in good condition for this ratio. On the next page, we have price divided by book, which shows the market valuation of a company relative to its book value. The results were higher than 1, which means Heinz is not in good condition for this ratio. Next, the price divided by sales that determining the relative trade-off between the price of stock. The results were higher than 1, which means Heinz is not in the good condition for this ratio. Next, the price divided by the earning to compare the company's stock price to its revenue. The results were higher than 1, which means Heinz is not in good condition for this ratio. On the next page, we have enterprise value divided by EBITDA that shows comparison of total valuation of the company with its ability to generate cash flow. The results were lower than 20, which means Heinz is not good condition for this ratio. And the last ratio, enterprise value divided by free cash flow, which determine the value of company. The results were higher than 10, which means Heinz is not in good condition for this ratio. In summary, even though Heinz is not always in good condition for the ratio, the several competitors have the similar result, which means the market is fluctuating from year to year. The Heinz results show that Heinz having competitive financial results if we compare it with its competitors. Next, I will explain about the financial statement. From the table given, we can make assumption that Heinz revenue has been increasing over the projected years, indicating potential growth in sales. The EBITDA figures show generally positive trend with slight increase over the projected years. This suggests that Heinz has been able to generate a consistent level of operating earnings. The EBIT figures also display a positive trend, indicating improving profitability. The projected EPS figures demonstrate a gradual increase, which suggests potential growth in shareholder value. From the statement of income table, we can make assumption that Heinz sales have been gradually increasing over the year period, which indicate growth in revenue. This suggests that there is a demand for Heinz product in the market. Hence, gross profit has remained relatively stable with a slight increase over the years. This indicates that the company has been able to manage its production costs effectively and maintain profitability. Hence, operating income shows a fluctuating trend that indicates some volatility in the company profitability. Hence, net income also shown some fluctuations. The company profitability was impacted during this period. From the balance sheets table, we can make assumption that Hence total current asset have increased. This indicates that the company has more liquid asset that can be used for immediate operational needs. And then hence total assets have also increased. The company's overall asset base has expanded, potentially indicating growth and expansions. Total current liabilities have increased, has more short-term obligation to meet, and hence total long-term debt and other non-current liabilities have decreased. This suggests that the company has been able to reduce its long-term debt burden. And the total equity remained relatively stable. The company net worth has experienced minimal change over the year. That's all for the financial performance analysis. I hope this information can be a reference in discussing the Heinz acquisition topic. Thank you.
Wow, we can see how promising this company is for the long term by the explanation from Mr. Handito. Thank you so much, Mr. Handito, for sharing your analysis with us. Before we start the interview with our guest, let me share you a short brief about our guest company, Berkshire Hathaway as a multinational conglomerate, and 3G Capital as a global investment firm. Let's see.
Berkshire Hathaway. 1958, Buffett noticed the Sanborn Map Company, which held a virtual monopoly on the production of detailed maps used in the insurance business. He had been investing its profits for the past 20 years in over 40 different stocks. Buffett naturally started buying up the Sanborn stock until he held the majority of the voting power. Warren's early investments followed the same philosophy. and unsurprisingly, they outperformed the stock market by a factor of 4. Warren encountered a cigarette butt that caught his eye, a struggling textile company called Berkshire Hathaway. Now Warren was stuck owning a declining company which he had no way to get rid of. Instead of letting Berkshire go to waste, Warren started investing in stocks through the company. But this bad experience dramatically changed his philosophy. Buffett applied his analytical skills to find the best stocks in the whole market. But that's only part of the reason he became successful. What really allowed him to make astronomical returns was his entry into the insurance business. Which is why in 1967 he started buying up insurance companies, beginning with National Indemnity and culminating with Geico in 1996. By 1983, Berkshire's portfolio was worth over $1 billion, and just 3 years later, Buffett himself was worth $1 billion.
We already see the explanation. Now, please welcome, intelligent people, the representation from Heinz Company, Berkshire Hathaway, and 3G Capital to the studio. Well, thank you, Mr. Gemilang, Ms. Reni, and Ms. Jihye for coming to IPMI Podcast. How are you? Fine.
Great.
Awesome. Thank you for being here. We are so glad to have the opportunity to discuss the Heinz acquisition that happened in 2013, the acquisition by Berkshire Hathaway and 3G Capital. That brings greater progress of Heinz Company to the following years. Let's start the basic, okay? What were the main motivations behind the acquisition?
The main motivation behind acquisition were to leverage Heinz strong brand and market position, capitalize on potential synergies and cost-saving opportunity, and tap into Heinz long-term growth potential.
Okay, next questions. What factors did Berkshire Hathaway and 3G Capital consider in negotiating to acquire Heinz Company?
We consider several factors such as Heinz financial performance, including its revenue, profitability, and growth potential. We also evaluated the company's financial stability and the potential for generating returns on our investment. Second, we also recognized the value of Heinz's strong brand power and market position. And we consider the company's reputation, customer loyalty, and comparative advantages in the food processing industry. Next, we consider how Heinz products, distribution channels, and market presence align with their long-term strategic objectives.
Also, we have looked for areas of overlap where operational efficiency and cost reduction could be realized. We have evaluated the expertise, experience, and track record of the management team to ensure they were capable of driving companies in the future success, and have evaluated the potential impact of the acquisition on shareholder value, any regulatory or legal implication that could impact to the deal.
Okay, and Mr. Gemilang, can you share with us how is the acquisition process? So 3 of you have a deal from $70 per share become $72.50. How the negotiation process?
We will negotiate about purchase price and payment structure between acquiring companies, Berkshire Hathaway and 3G Capital, and of course, Heinz, with comprehensive analysis of Heinz financial record, operation assets, liabilities, contract, and other relevant aspects. So, with good communication skill and negotiation skill, once all necessary approval from stakeholders and all regulatory documents are obtained, the acquisition is finalized. Hence, agree with purchase price.
Yeah, I can imagine it will a long process of negotiation, right?
Right, Michelle. The acquisition merger process took about 6 months. It began with the proposal and negotiation in December 2012, and the actual acquisition agreement was reached in February 2013. Accordingly, the term and other details were negotiated, and finally the acquisition was completed in June 2013 after obtaining shareholders' approval.
To achieve this agreement, of course, Heinz also influenced the shareholders and stakeholders. Mr. Gemilang, can you share with us what could be the future consequence for shareholder, management, employees, and the citizens of Pittsburgh?
In the long term, the future consequence for a stakeholder could lead to an increase the company value and the potential high stock price. For management, this is a positive change for a member of Heinz family to a professional. New management which could impact to the company's strategic direction and decision-making process. Effectively, cuts costs and eliminated excess debt. The acquisition could bring both opportunities and challenge for employees. Competent employee will be retained, while incompetent employee will lose their jobs. On one hand, it may lead to the new growth prospect and potential job security. After the acquisition, Heinz still be headquartered in Pittsburgh, ensuring local employee and tax revenue for the benefit of the city. The acquisition could bring investment and potential job opportunity to the city, of course.
Well, so it is a fair deal for three of you?
The fairness of deal Heinz company by 3G Capital and Berkshire Hathaway is the subject and depend on the various factors. For the following reason, the acquisition between this company is considered relatively fair.
Heinz was offered a premium for the acquisition that was almost 21%, higher than $60 closing price from the day before. This premium is comparable to the 20% historical average since the period and suggests that the offer was attractive to Heinz shareholders. They approved to the acquisition, of course.
Also, the negotiation process between Berkshire Hathaway, 3G Capital, and Heinz is a critical factor in determining whether a deal is fair or not. The negotiation process and the involvement of investment banks played an important role in enhancing the fairness of the negotiation process and creating an environment where both parties can benefit fairly.
Yeah, I'm agree. It was a very fair deal for three of you. Well, I can see that in the long term, hence, Berkshire Hathaway and 3G Capital become stronger and more profitable. Last questions. What lessons can others company or intelligent people may see and learn from the Heinz acquisitions? Please, Mr. Gemilang, Mrs. Jihye, and Mrs. Reni, give me one insight from each of you.
Recognize the value, strong brand, and market position. Heinz had a well-established brand and strong market position in the food processing industry. Other companies can learn the importance of recognizing and leveraging the value of the strong brands. Building and maintaining a strong brand can lead to a customer loyalty, increased market share, and the competitive advantages.
Identify synergies and cost-saving opportunity. The Heinz acquisition was driven in part by the potential synergies and cost-saving opportunity that could be achieved through the combination operation. Other companies can learn the importance of truly evaluating potential synergies and cost-saving opportunity when considering an acquisition. Identifying area of overlap and streamlining operation can lead to improved efficiency, reduce costs, and also increase profitability.
Evaluate the long-term growth potential. Berkshire Hathaway and 3G Capital likely consider the long-term growth potential of Heinz when making the acquisition decision. Other companies can learn the importance of evaluating the growth potential of a target company. Assessing factors such as market trends, product innovation, and expansion opportunities can help determine the long-term viability and potential returns of an acquisition.
Thank you for sharing your insights on the Heinz acquisition case. Based on our discussions, we can learn valuable lessons from this case, such as the importance of recognizing and the value strong brands, identifying synergies, and evaluating growth potentials when considering an acquisitions. Thank you once again for your time and valuable insights. It was a pleasure having you here today. Thank you. And it's wrap for today's episode of IPMI Podcast. I hope you find it informative and valuable. Intelligent people, if you enjoy this video, share it with other intelligent people and be sure to like and subscribe to our podcast. Also, don't forget to leave us a comment what the topic we should discuss next. Okay, until next time, intelligent people, stay curious and keep exploring. We are from Group 5, want to say thank you, Mr. Rupi, for lecturing
us. Thank you.